There is a word in this market that almost nobody in retail finance uses correctly. Most people have never heard it in the context of silver. Most financial analysts will not say it on television because the moment they do, the question that follows cannot be answered comfortably. That word is backwardation. And right now, on Wednesday, March 11th, 2026, the silver market is in backwardation. Not a minor technical deviation, a sustained deep inversion of the futures curve that has been running since late 2025 and has not resolved despite the January crash from 121.67, despite the margin hikes, despite the paper price sitting at $86 and change this morning. Backwardation means one thing in simple English. Silver you can put in your hand today is worth more than silver promised to you for delivery months from now. And in a market that has been built on the assumption that paper promises and physical metal are interchangeable, that assumption is the foundation of a system where 356 paper claims exist for every single physical ounce of silver. Backwardation is the signal that the assumption is cracking. The coat check handed out 356 tickets. There are 100 coats, and people have started showing up at the counter asking for their coats right now, not later, now. OG John AG here. This is financial warfare education, not advice. That means we go through both sides completely. We are going to look at exactly what the backwardation data is telling you, what the COMEX delivery record underneath it means, and why 2026 is structurally different from the 2021 retail squeeze that failed. And we are going to be completely honest about the bear case, and because there is a real version of this story where the system manages the stress and the paper price proves more right than the physical signal suggests. Let me show you what the data actually says. Segment 1, Confirmed Facts, March 11th, 2026. Let me start with confirmed facts, because in a market this loud, confirmed versus rumored is the most important distinction you can make. Confirmed. Silver spot price this morning, $86.05 per ounce, down 3.95% on the day after February's CPI came in exactly at consensus, 2.4% annually, 0.3% monthly. Confirmed. Silver opened 2026 at approximately $70 per ounce. It printed an all-time nominal high of $121.67 on January 29, 2026, the highest price in the entire recorded history of the metal. It then crashed 33% in less than 30 hours following CME Group margin hikes from 15% to 18%. It is currently sitting 23% above where 2026 began, even after that historic collapse. Confirmed. Silver lease rates, the cost to borrow physical silver from institutions that hold it, spiked to approximately 8% annually by January 2026. Normal lease rates in a well-supplied silver market sit between 0.3% and 0.5%. During the October 2025 squeeze that preceded this one, London lease rates briefly hit 39% before settling between 14% and 30%. An 8% lease rate in a market where the baseline is 0.5% is not noise. It is a signal that holders of physical metal are increasingly unwilling to lend it even temporarily. Confirmed. COMEX silver is in backwardation. Nearby contracts are trading at higher prices than deferred contracts, the opposite of the normal contango structure, where storage and financing costs make future deliveries slightly more expensive than spot. The backwardation in silver futures is the most sustained inversion since the early 1980s. The entire curve through late 2026 is inverted, meaning the market expects physical scarcity to persist not for days or weeks, but for the duration of the curve. Confirmed. COMEX registered silver inventory, 81.2 million ounces as of March 6, 2026, down 64% from 240 million ounces in April 2020, down 31% from levels seen only months prior. Confirmed. January 2026. COMEX silver deliveries, 49.2 million ounces, 10 times the delivery volume in January 2024. February 2026 deliveries, 25.18 million ounces, 5 to 8 times historical norms for February. Combined 60-day delivery total, 74.38 million ounces, the highest 2-month physical delivery figure in exchange history, confirmed. On first notice day for the March contract, February 27th, 10th, 526 contracts immediately stood for physical delivery, 52.63 million ounces, against a registered inventory of 86.13 million ounces, more than 60% of the entire deliverable pool demanded on the first day of a single delivery period. Confirmed. The Silver Institute confirmed the silver market is heading for its 6th consecutive year of structural deficit in 2026, cumulative deficit since 2021, approximately 820 million ounces. Projected 2026 deficit, 67 million ounces. Confirmed. China reclassified silver as a strategic material and restricted its export. China controls approximately 60% of global silver refining. Chinese silver refining costs surged 16.9% year over year through early 2026. Confirmed. 75% of global silver production is a byproduct of base metal mining: copper, lead, zinc. You cannot simply increase silver output by deciding to mine more silver. The supply response to higher prices is measured in years, not months. Those are the confirmed facts. Everything after this is analysis. Segment 2. The coat check. Why the 356.1 ratio is the most important number nobody is talking about. Let me explain the structure of the silver market in the simplest possible terms, because once you understand the mechanics, everything else in this video clicks into place. Imagine a coat check at a restaurant. You have 100 coats physically hanging in the closet. That is your registered physical silver inventory. The management has handed out 356 claim tickets. As long as everyone does not show up at the same time to collect their coat, the system functions. Most people are happy to leave their ticket in their wallet for months or years. They are not in a hurry. The system works on the assumption that not everyone collects at once. That assumption has been the operating principle of the COMEX silver market for decades. Here's what has changed in 2026. People have started showing up at the coat check counter. Not all of them, but enough. In January, they showed up and took 49.2 million ounces. In February, another 25.18 million ounces. On the first day of March delivery, 52.63 million ounces were immediately demanded. The coat check does not have enough coats for everyone who is asking right now. The total paper claims against physical silver, when you include COMEX futures, ETF instruments, London OTC positions, and derivative markets across the entire silver complex, are estimated by analysts at approximately 356 paper ounces for every one physical ounce that actually exists in a deliverable form. Now here's the critical detail. The 356.1 ratio does not mean the system is fraudulent or that it was always designed to fail. Fractional reserve systems work when the holders of claims behave as the system assumes they will, passively, patiently, not all demanding physical delivery simultaneously. What changes the equation is behavior. Specifically, what changes everything is when industrial users, institutional buyers, and sovereign wealth funds decide they would rather hold the actual metal than a claim on the metal. That behavior change is exactly what the delivery records are documenting. The buyers pulling 74.38 million ounces from COMEX vaults in 60 days were not retail investors panic buying eagles. These were entities standing for COMEX delivery. Institutional participants, industrial users, and large commercial buyers taking physical bars into their own custody because they have concluded that a paper claim on silver and actual silver in a vault under their control are not the same thing in the current environment. When that conclusion spreads, when enough claim holders decide they want the coat rather than the ticket, the coat check runs out of coats. And the backwardation is telling you that conclusion is already spreading. Segment 3. What backwardation actually means and why this one is different. Let me explain. Backwardation precisely because the word gets used loosely and the precision matters. In normal commodity markets, futures prices trade at a premium to spot prices. This is called contango. It exists because of storage costs, insurance costs, and financing costs. The expenses involved in holding physical metal for future delivery. If you can buy silver today at $86 and deliver it in 6 months at $87.50, the $150 difference covers the cost of carrying the metal. This is the normal structure. Backwardation is the inversion. Spot silver today is worth more than silver promised for future delivery. The market is saying, I need metal now. I am not confident the future promise will be fulfilled. I will pay a premium for immediate delivery over deferred delivery. When backwardation is shallow and brief, it typically reflects a temporary regional supply disruption. Metal in the wrong place, a logistics bottleneck, a short-term delivery crunch that resolves within weeks. When backwardation is deep and sustained, when the entire futures curve through late 2026 is inverted, when lease rates have been running at 8% against a normal baseline of 0.5%, when the inversion has persisted through a 33% paper price crash and multiple margin hike cycles, it is not a temporary logistics problem, it is a structural signal. The data confirms this distinction clearly. Silver's current backwardation is the most sustained inversion since the early 1980s. The 1980 episode occurred during the Hunt Brothers squeeze, when physical silver became genuinely scarce relative to the paper claims against it, and the price ultimately reached the equivalent of over $200 in today's purchasing power before the exchange changed the rules mid-session and forced cash settlement. The crucial difference between 1980 and 2026 is the nature of the demand. In 1980, the demand driving the backwardation was two wealthy brothers making a speculative bet. When the exchange ended that bet by changing the rules, the backwardation resolved. In 2026, the demand driving the backwardation is solar manufacturers who cannot run their production lines without silver, EV producers who cannot ship vehicles without silver, AI data center operators whose thermal management systems require silver, defense contractors building missile guidance systems and radar arrays that have silver specifications written into contracts with the United States government. These buyers cannot accept cash settlement. They need the metal, and their need does not disappear because the exchange hikes margin requirements or declares a new rule. That is the structural difference. The 2026 backwardation is not speculative. It is industrial, and industrial demand does not get margin called. Segment 4. Why 2026 is different from the 2021 retail squeeze. Let me address the comparison that every silver bear is going to make, because it is a fair comparison and it deserves honest treatment. In February 2021, following the GameStop retail short squeeze, a Reddit-driven campaign targeted silver. Silver futures rose approximately 13% in a single day. Retail dealers reported unprecedented demand. Online dealers had queues and sold-out pages. It looked briefly like the squeeze was beginning. It fizzled. Within days, the price retreated. The squeeze had no lasting impact on the paper market. Why? 2 reasons. First, the community was divided. Many argued the silver campaign was a distraction from GameStop and AMC, the original squeeze targets. Momentum fractured. Second, and more critically, most of the retail buying flowed into paper silver ETFs, primarily SLV, the iShares Silver Trust. When you buy SLV, you are not creating physical delivery pressure on the COMEX. You are buying a financial instrument. The metal backing SLV may be leased or hypothecated. You cannot redeem SLV shares for physical silver below a very high minimum threshold. Retail SLV buying put money into a paper instrument. It did not drain COMEX registered inventory. It did not create delivery obligations. The paper market absorbed the buying without any physical stress whatsoever. The 2026 situation is mechanically different at every level that matters. The entities pulling 74.38 million ounces from COMEX vaults in January and February were not Reddit users buying SLV on Robinhood. They were standing for COMEX delivery, a process that requires actually taking physical bars from certified vaults. Industrial users are negotiating offtake agreements directly with primary silver producers, bypassing COMEX entirely because they cannot risk depending on exchange delivery in a backwardated market. Major electronics and solar manufacturers are reportedly locking in multi-year supply contracts directly with miners because their production lines cannot operate on just-in-time exchange delivery in the current supply environment. The 2021 squeeze failed because the buying was paper. The 2026 stress is physical. The delivery records are the proof. You cannot fake COMEX delivery reports. When 74.38 million ounces walk out of registered vaults in 60 days, that metal physically moved. Someone took delivery. Someone now has bars in a vault that is not COMEX. That metal does not return to the registered pool automatically. It is gone from the exchange system until the holder decides to register it again, which they will not do at current prices if they believe the price is going higher. This is not a retail speculation event. This is a fundamental supply-demand dislocation playing out in the exchange delivery mechanism in real time. Segment 5, the supply side. Why you cannot simply mine more silver. Let me address the supply response question directly, because every honest analysis of a commodity squeeze has to answer it. The bear case on silver supply always runs the same argument. Higher prices incentivize more production. Mine more silver, supply increases, price normalizes. That is how commodity markets work. The argument has merit in theory. It does not survive contact with silver's specific geology and production structure. Approximately 75% of global silver production is a byproduct of other mining operations, primarily copper, lead, and zinc. This is not a coincidence. Silver occurs in ore bodies alongside these base metals. When miners develop a copper or zinc deposit, silver comes along whether they want it or not. The economics of that silver production are driven by copper and zinc prices, not silver prices. A silver price of $86 does not incentivize a copper miner to expand their copper operation. They expand when copper economics justify expansion. Silver is the passenger, not the driver. For primary silver mines, operations where silver is the primary economic product, the production timeline is the second barrier. From discovery of a viable silver deposit to first production is 7 to 10 years. Permitting, environmental assessment, mine design, capital construction, commissioning, and ramp-up. You cannot accelerate a permitting timeline by offering to pay more per ounce. The bureaucratic process does not respond to silver price signals. Even at existing operations, ore grade decline is a structural reality. Fresnillo, the world's largest primary silver producer, reported a 12.3% production decline in 2025 and guided to another step down in 2026, citing structural ore grade deterioration at their flagship mines that cannot be reversed by a price incentive. China's export restriction adds a third layer. China controls approximately 60% of global silver refining. When Beijing restricts silver exports, the metal refined inside China largely stays inside China. The global arbitrage that would normally equalize supply, buy cheap elsewhere, deliver to where demand is operating against a regulatory wall. The supply response that should arrive in response to $86 silver, that should, according to standard commodity theory, resolve the backwardation and close the deficit, is not coming on a timeline that matters to the industrial users placing delivery demands today. Segment 6. Paper silver versus physical silver, a distinction that matters now more than ever. Let me be direct about a distinction that most retail investors have not fully processed. If you own SLV, the iShares Silver Trust, the world's largest silver ETF with over $22 billion in assets, do you own silver? Legally, you own shares in a trust that holds silver. The silver backing those shares may be leased to other parties. It may be hypothecated, pledged as collateral for other financial transactions. You cannot redeem SLV shares for physical metal below very large minimum amounts. In a scenario where the paper-silver system comes under severe delivery stress, where the backwardation deepens, where COMEX registered inventory continues declining, where more industrial users demand physical settlement rather than paper settlement, SLV shares and physical silver bars in your possession are not the same asset. This is not a fringe argument. This is the mechanical reality of how the instrument is structured. The SLV prospectus itself acknowledges these risks. PSLV, the Sprott Physical Silver Trust, is structured differently. It holds fully allocated physical silver bars stored at the Royal Canadian Mint. The silver is not leased. It is not hypothecated. Larger holders can redeem shares for physical metal. The trade-off is a higher expense ratio and a premium or discount to net asset value. But what you own when you hold PSLV is a claim on specific allocated physically stored silver bars, not a financial instrument whose silver backing may be encumbered. The distinction matters most when the system is under stress. Under normal conditions, SLV and physical silver track each other closely enough that the structural difference is academic. Under the delivery stress currently documented in the COMEX reports, with registered inventory at 81.2 million ounces and 74.38 million ounces delivered in 60 days, the structural difference between a paper claim and physical possession is not academic, it is the entire question. Physical silver in your possession has no counterparty risk. No one can change the rules on it. No exchange can declare cash settlement on metal you are already holding. No margin call can force you to sell it. It is the one form of silver exposure that the paper market mechanics cannot reach. Segment 7, the honest bear case. Now the other side, full and honest. Bear argument 1. The exchange has tools and has used them. CME Group hiked silver margins from 15% to 18% in January. That hike was a direct response to the delivery stress. It increased the capital required to hold large positions, forcing weaker hands to close or reduce. The exchange can hike margins again. It can introduce position limits. It can offer cash settlement bonuses to incentivize long holders to accept cash rather than demand physical delivery. COMEX has never defaulted in its history. When delivery stress has built up before, the exchange has found mechanisms to manage it. Assuming that the same tools that worked in 1980, in 2008, and in 2020 will work again is not an unreasonable assumption. Bear argument 2. The 2021 squeeze failure is more instructive than silver bulls acknowledge. Despite all the structural arguments made in 2021, the supply deficit, the industrial demand, the fractional reserve system, the squeeze failed. The paper price retreated. The physical delivery pressure dissipated, not because the structural arguments were wrong, but because the system found equilibrium through mechanisms that do not always show up in the bullish analysis. Higher prices stimulated scrap recycling. Industrial users reduced consumption where possible. Eligible silver holders registered their metal for delivery when prices reached levels that justified the transaction costs. Bear argument 3. Solar thrifting is real and potentially accelerating. Solar panel manufacturers are actively reducing silver loadings per panel and developing alternative contact technologies. If the transition to lower silver or silver-free photovoltaic technology accelerates at high prices, the industrial demand floor that underpins the backwardation thesis weakens. Industrial substitution at $100 or $150 silver could meaningfully reduce demand over a 3 to 5 year horizon. Bear argument 4. China's export restriction could be reversed. Policy decisions can change. If the geopolitical environment shifts, if a trade negotiation produces an agreement that modifies silver export controls, the supply constraint that is amplifying the current delivery stress could ease faster than the structural deficit data suggests. I am presenting these arguments seriously because they deserve serious engagement. The bear case is not irrational. The exchange has demonstrated resilience. The substitution risk is real. Policy reversals happen. What the bear case does not resolve, the 74.38 million ounces physically delivered in January and February. That metal moved. It left the COMEX system. It is in private hands. The lease rate's at 8% against a 0.5% normal. The backwardation across the entire futures curve through late 2026. The sixth consecutive year of supply deficit. The Fresnillo production decline. China's export restrictions. None of those data points changed because the paper price dropped 3.95% on a Wednesday morning CPI print. The bear case changes the timeline. It may change the magnitude. It does not change the direction of the physical supply picture. Segment 8. 3 scenarios. Honest probability assessment. 3 scenarios. Honest probabilities on each. Scenario 1. System manages the stress. CME Group successfully manages the March delivery cycle through margin adjustments and cash settlement incentives. April and May delivery demand normalizes toward historical levels as the speculative overlay stays off the table following January's crash. Backwardation gradually resolves as eligible silver holders register metal for delivery at prices that justify the transaction costs. Lease rates return to below 3% by Q2. The paper price holds in the $80 to $95 range. JP Morgan's $81 annual average is close to right. The structural deficit continues but does not accelerate. The 2026 squeeze story follows the 2021 pattern. Real structural pressure, real delivery stress, managed resolution. This scenario is possible. It has historical precedent. I am not dismissing it. Scenario 2. Delivery stress compounds through Q2. March delivery cycle processes at elevated levels. Final tally above 40 million ounces. April and May open interest builds while registered inventory continues declining. Industrial offtake agreements with primary miners increase, further reducing the pool of metal available for COMEX delivery. Backwardation deepens rather than resolves. Lease rates move back toward 15% to 20% as the October 2025 pattern repeats. The paper price begins converging toward the physical reality. Not in a single violent move, but in a sustained compression of the gap between paper promises and physical availability. Silver moves from $86 toward $100 to $120 through Q2, as the ratio compresses from 61 toward 50. This is my current base case. The delivery data supports it. The inventory trajectory supports it. The structural deficit data supports it. Scenario 3. Physical delivery mechanism breaks visibly. COMEX registered inventory falls below 50 million ounces while March or April delivery demand exceeds what the exchange can fulfill through normal mechanisms. The exchange announces emergency cash settlement provisions, paying longs above spot price to accept cash rather than physical delivery. That announcement, if it comes, is a public confirmation that the paper system cannot deliver physical silver at the scale the paper claims suggest. The backwardation explodes. Lease rates spike back toward October 2025 levels or beyond. Industrial users accelerate direct procurement from miners, further disintermediating COMEX. The gold to silver ratio compresses toward 40 as silver's physical scarcity becomes undeniable in official exchange data. $150 silver is the first structural target. I am not predicting scenario 3 as the base case. I am telling you that every week the inventory continues draining at its current pace. Scenario 3's probability increases relative to scenario 1. Segment 9. What to actually watch your watch list. All public, all free. COMEX registered silver daily warehouse report from CME Group. If registered inventory continues declining from 81.2 million ounces, the pace has been approximately 785,000 ounces per day recently. Watch whether it approaches 60 million ounces while March delivery demand remains elevated. Below 60 million against current delivery pace is structural stress territory. Silver lease rates. Check daily through data providers like Kitco or Bullion Vault. Normal is 0.3% to 0.5%. Currently approximately 8%. If lease rates move back toward 15% to 20%, the October 2025 level, the stress is reaccelerating, not resolving. If they decline toward 3% to 4%, the immediate delivery pressure is easing. Silver futures curve structure. Check whether nearby contracts are trading above deferred contracts, backwardation, or below, contango. If the curve returns to contango, the structural stress signal from the physical market is normalizing. If backwardation deepens or extends further along the curve, it is intensifying. March COMEX delivery final tally. CME publishes monthly delivery reports. The first notice day showed 10,526 contracts, 52.63 million ounces, immediately standing for delivery. The final March tally, available by month end, will tell you whether the exchange successfully managed the delivery cycle or whether the delivery demand set another record. Physical dealer premiums. JM Bullion, APMEX, Gainesville Coins, SD Bullion. If Silver Eagle premiums are running above $8 over spot consistently, and if delivery timelines are extending toward 3 to 6 weeks rather than days, the retail physical market is confirming what the institutional delivery data is showing. Shanghai COMEX spread. If Shanghai is paying $14 more per ounce for silver than New York, as it was doing as recently as yesterday, and that gap is not closing through arbitrage flows, the physical market globally is tighter than the COMEX paper price reflects. Outrow, I sell nothing. No courses, no Discord, no signal groups, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. Here's where the data puts us on Wednesday, March 11th, 2026. The paper market says silver is 86.05. The COMEX delivery reports say 74.38 million ounces of physical silver were removed from registered vaults in the first 60 days of the year, the highest 2-month delivery figure in exchange history, not by retail investors buying ETFs, by entities standing for physical delivery and taking bars into their own custody. The lease rate data says it costs 8% annually to borrow physical silver in a market where 0.5% is normal. Physical silver holders are not willing to lend their metal at any price that was considered adequate 6 months ago. The futures curve says the entire forward structure of silver prices through late 2026 is inverted. Today's metal is worth more than tomorrow's promise. That is not a trader's preference. That is a market signaling that it is not confident the promises will be kept. The supply data says 75% of silver production cannot be accelerated by a price signal, 7 to 10 years to open a new mine. Fresnillo guiding production lower for the second consecutive year. China restricting exports of the one country that refines 60% of the world's silver. The deficit data says this is the 6th consecutive year that the world will consume more silver than it produces. 820 million ounces of cumulative deficit since 2021 has already been drawn from above-ground stocks. The coat check has been handing out tickets it does not have coats for since 2021. 2026 is the year people started showing up in large numbers to collect. The paper price and the physical reality are not describing the same market. They are always eventually forced to speak to each other. The delivery records, the lease rates, the backwardation, and the inventory trajectory are all telling you which one moves to meet the other. This is financial warfare education, not advice. Pull the COMEX warehouse report yourself. Check the delivery data. Watch the lease rates. Watch the futures curve. And never confuse a paper price with what a real buyer has to pay to put real metal in their hand right now. Drop OG John AG in the comments and tell me, are you watching the COMEX delivery data or the paper price? I am reading every single comment. OG out.